Okay, so Daniel, thanks very much for being here with us today on the Poundcast, the Digital Pound Foundation's podcast. It's great to have someone who's such an expert in tokenization, which is obviously closely linked with the development of different forms of digital money. So we'd love to just hear a bit from you about your background, what you do, what Tokeny does, and how you got involved in digital assets.
Well, thank you very much, Helen, for inviting us. So I'm Daniel. I'm one of the co-founder of Tokeny. So my background is in traditional finance. I spent around 10 years at Clearstream Banking. So for those who are not familiar with Clearstream, Clearstream is a central security depository, one of those market infrastructure that are required in order to manage counterparty risk. And I spent another 10 years in clearing, but for telco, very similar to what we were doing at Clearstream, but with other type of data. But it was still, a transactional based platform. This journey was quite successful. I ended up, doing a small exit, and I started to invest in startup. I think I've always been an entrepreneur, but sometimes you don't have a choice. So you are an employee, but I always had some side activity. So there it gave me the opportunity to come back to entrepreneurship. So I was a coach in an incubator in Paris for about 10 years. And this is how I started to invest in startup, met our current CEO, Luc, when he was 23, was his first venture. So I invested in his company, and after 4 years, we exited that company, and he approached me with the idea of doing Tokeny. At that time, the market fit was really about developing a marketplace for facilitating the onboarding of investors and ICOs, utility token offering. But having a background in traditional finance, I really believe that this had the potential to transform, market infrastructure broadly, so for capital market. So I invested in the company, and after a couple of months, and bringing Luc to Luxembourg, where I thought this would be the epicenter for addressing the investment fund industry. Then I joined full time and help him grow the company from a business development perspective and strategic selling. And this is what I've been doing for the last 7 years. So this obviously explain a bit the early days of Tokeny. So we address this booming market of ICOs. What was interesting in those ICOs is that it was the first time that you had this notion of smart contract. And obviously, we all know Bitcoins, and we all know how this technology highlighted how you could transfer value instead of just copying value, which, of course, if the idea is to represent money, is essential. But smart contract really demonstrated how you can program certain basic conditions. And in that case, this basic condition was a DVP, deliver versus payment, right? So you wouldn't get the token if you didn't pay the money, that you were supposed to pay. And this was obviously the first really smart contract, ERC20, developed by Fabian Vogelsteller. And we realized then the potential of using that technology in order to represent financial instruments on chain. The problem with the ERC20 is that it is not permission, meaning that if the condition is met, which is you have the money, I have the securities, then the smart contract will execute. However, if you start dealing with securities, there can be far more complex conditions that you need to enforce. And the most important one and basic one is KYC. And in the KYC, there are also other conditions that needs to be met, like, is it an accredited investor? Is it a qualified investor? What is his country of residence? And clearly, we realized that the ERC20 was not sophisticated enough to take into consideration those complexities. So we developed a new framework. At the time, it had as a code name T-Rex. In the meantime, it is now an official standard from Ethereum, which is referred to ERC3643. So we developed it for about 5 years. We are at V4 release now. And last year, we decided to submit it as an official standard to the Ethereum community. Actually, we decided to do that 3 years ago because this is a long process, but it reached final stage last year. And at the same time, we created a nonprofit association, the ERC3643 Foundation, which now counts 75 members, to really promote it as the industry standard to represent digital assets on chain.
Yeah, it's super interesting how it's all evolved because, obviously there's many different types of tokens on blockchains. There's tokens as money or currency like Bitcoin. You mentioned utility tokens, this idea of being able to, use the token on a network for a purpose. Then you've got security tokens. So we're now moving into the world of financial instruments, and obviously different sets of rules and regulations and standards start to apply when you're dealing with the regulated financial markets. And I guess, that's where the sort of story begins in terms of our listeners and where they might be interested in this, because obviously as Digital Pound Foundation, we're looking at the development of different forms of digital money, whether it's a digital pound in the form of a central bank issued digital currency, or whether it's privately issued stablecoins, and how those might link in with this growth of tokenization that's sort of exploding. So, you have touched already, I think, on some of the origins and some of the potential benefits of tokenization, but maybe just talk a little bit about where the market is now in terms of the current status of tokenization.
Well, I guess that as an outsider, you would probably say that, this is not moving fast enough. And I probably would agree with that. But in reality, from an insider, what we see is that all large financial institutions, not only the large one, but all financial institutions understand now the potential of this technology. So it's really a technology that is going to change the way we use infrastructure, market infrastructure, and the role of those market infrastructure. So as we have that common understanding, or the market has that common understanding, I think that all large financial institutions, and medium, small one as well, they started to either run pilots to understand, how to operate the technology, and for a lot of them, they've already started to build infrastructure on their end in order to operate on such an infrastructure. So one has to understand that this is so sensitive. We're talking about replacing market infrastructure, that this is not something that can happen overnight. And as I usually explain it, before large financial institutions start the journey to change the infrastructure, they first need obviously to assign budget to that initiative. Then they need to assess technology. They need to pick up a technology. They need to implement that technology in the pilot or POC phase. And once obviously they understand the risk associated with the technology and the benefit, then they can start deploying this technology more broadly. And it always starts with one asset. You don't, it's not binary. You don't bring all your assets overnight. So there's a journey for any financial institution to start using this this infrastructure. So typically, the cycle for changing technology that is essential to your infrastructure is between 5 to 10 years. So this this journey from Tokeny perspective started 7 years ago, but for numbers of years, we were still dealing only with ERC20 and utility token. Around 5 years ago, we started moving to what it is today, the ERC 3643 framework, and representing financial instruments. And probably, the journey from financial institutions started more or less at the same time. So we are more or less at midterm with regards to, the potential of this technology for becoming mainstream. Very often people ask me the question, when do you think it will become mainstream? Well, as I said, it's between 5 to 10 years in order to really see some visible use of the technology that will therefore be at a certain scale as well. So we are probably midterm in terms of implementing this technology. So I think that in the next 3 to 5 years, we'll see volume ramping up and obviously more use case. And as there are more use cases, then you will also see more benefit, because unavoidably there is the infrastructure side of things, which is really about creating more operational efficiencies. But there is also the I would say the decentralized benefits that you can create by using this technology. And to get those benefits, you need to have some critical mass. You cannot obviously start creating, for example, liquidity on those assets if you don't have assets and if you don't have enough buyers on the other hand. So as you will see that there will be more adoption in the market, then you will also see more benefits coming from decentralization, and therefore more adoption, which probably will have this hyperbolic type of adoption rate, and then it will become mainstream, and nobody will talk about blockchain anymore, as nobody's talking about internet and how you set up an email in your inbox. So it will become transparent, and everybody will be using it behind the scene.
Yeah, and let's just talk about the benefits then, because obviously the world is going digital, so maybe we'll have digital fiat currency and lots of other things we do are digital, but it's more than just going digital with the security, isn't it? There are some innovative benefits that are beyond simply digitizing. So can you just talk a bit about the benefits of tokenization for the world of traditional finance?
Well, as you rightly said, I think there's the obvious benefits about digitalization, which does not have to happen on chain, right? A lot of the workflow that happen today in traditional finance are still, in I would say, paper format, whether we like it or not, or using old infrastructure. So I think the digitalization is not trivial, but it does not have to happen on chain. So, but we see that as a parallel process happening on the top of the blockchain, and using the blockchain then to really have a representation that will bring the benefits. So the first, I would say, immediate benefit is really about upgrading your infrastructure. And this is not trivial, because if you look at, for example, the fund industry, you'd be surprised by the number of transfer agents that are still using Excel macro in order to keep the book of record of funds. So, and recently I was talking to one transfer agent that have had major problem because of using those Excel sheets and macros. So it's important for those companies to upgrade their technology because obviously, as the rest of the market started to have more effective technology and also a kind of access to new lines of service and revenue model, if you don't upgrade your technology now, you'll be running behind, and you're going to have problem to keep up with the speed of the market at that time. So, and those operational efficiencies, of course, they don't need to happen on public blockchain. They can happen on private chain. You can get the benefit of upgrading your infrastructure and having more efficient operational workflows by operating on a decentralized infrastructure that is private, for instance. But definitely, allowing you to reduce your costs is not trivial, because this industry today has not been focusing at all for the last decades on operational efficiency, because they were too busy coping with the increase of activity. The private equity business has been booming, so you were just adding people in order to manage the growth and not focusing about how to do that from an infrastructure perspective. So now, obviously, I think that people realize that it's time to look at infrastructure in order to create those operational efficiencies. And this is probably where we get most traction for the time being, because people realize that this is what they need to do in order to be ready for tomorrow. At the same time, obviously, we're pushing for this digitalization to happen on chain, because if you indeed look at restructuring or upgrading your infrastructure, why don't you do it on chain? Because then you will have the benefit of decentralization, which will not necessarily become in the short term, because, as I said, in order to get those benefits, you need some form of decentralization. But as you have your infrastructure ready, then you can start indeed addressing those opportunities. And those opportunities will be coming mostly from liquidity, increasing liquidity. And liquidity is a broad term. I'm not referring to liquidity solely for secondary market, because most of the people are referring to secondary market because this is what's happening on crypto exchange, on Coinbase, on Binance. People are trading crypto, and in essence, those instruments are liquid. So it's clear that you have liquidity because there is already critical mass. But in private market, you don't have liquidity because you don't have enough critical mass. But this liquidity is a broad term, because on one end, you can increase distribution capability, which in turn is increasing liquidity. You can use the representation of those assets to collateralize those assets, which will increase liquidity as well. And ultimately, when you have enough critical mass, then you can start to have a secondary market and there have liquidity in those secondary markets. So I believe that this is where we see now the benefit of this technology. However, I think there will be far more benefits behind this technology. If you look at the early days of like Apple or Android, for that matter, in the App Store, you had 500 applications. That was 15 years ago. Now there are 2 million applications. So you have to understand, and once you represent data on chain, you can, of course, and that's mandatory, control the data. That's the role of custodian. That's the role of transfer agent. They are mandated in order to keep the book of record, control KYC, AML, etc. on those investors. They control the data, but they can then let this data being accessible by third-party application that will create more value for this data, for those investors, or for those assets. So think about a world of application that will be developed by a community of smart people coding in Solidity, which is a common language on Ethereum. So think about the numbers of applications that can be plugged into this data in order to enhance the value for issuers, investors, etc. So I think that the world of finance will be dramatically different in 10 years from now than as we know it today.
Yeah, I think that whole trend towards the data, and obviously being able to use AI potentially and machine learning to analyze some of this data and help people make investment decisions through, understanding different trends and so on. That's going to be really interesting. And see how
they may not even decide by themselves, right? They will have recommendation. And to your point, if you start plugging this data, which, and again, this is not trivial, will be represented on chain. So the fact that it is on-chain does not mean it's public, by the way. There are ways, and this is what we do with on-chain ID, to create some form of anonymity on this data. But you will enable third party to access this data and provide recommendation, based on your risk profile, your appetite profile, and that recommendation can be indeed enforced almost automatically by using tokenization and a complete tokenized kind of workflow from the issuer until the custodian. And then you will end up having in your wallet the exact investment product that reflects your appetite for risk, your appetite for type of assets, your appetite for geographical distribution. Think about it.
Yeah, it's really, really interesting and exciting, I think. And just talk a little bit about the process of tokenization. So let's say an organization wants to tokenize a piece of real estate or something like that. What's the process? How does that actually come about?
So one thing obviously that doesn't change is that you're dealing with the financial instruments, and there are rules that are attached to that financial instruments. So you have a regulatory framework where you issue the instruments, where you distribute it. So we don't want to change any of those existing rules. Now, of course, one is to recognize that as you do that on infrastructure that have more capability, then certain, I would say, operation will probably be not required anymore. But the reality is that the regulatory environment, being from a legal perspective or from a tax perspective, do not change. So you first need to understand what you're dealing with, right? At the end of the day, the process of tokenization is just representing those instruments on infrastructure that is more efficient. So you could do that on Excel. And for doing that, you just need Excel. So I would say that's a dumb representation, very binary. Or you can do that using smart contract and represent that on blockchain. So there you obviously need to have solution that enable to take into consideration all those obligation and to code in a way those obligations into smart contract. And this is where the ERC 3643 came into play, because we've built a framework that is flexible enough to represent any financial instruments, any type of assets, being issued in any type of jurisdiction and being distributed in any jurisdiction. So this is a framework that is open source. The benefit of being a framework that is being fully audited. So what you change is not the code. What you change is the variable elements that are linked to your issuance. So use this framework and the software that Tokeny has been developing enable you to represent into the smart contract, open source smart contract, the variables of your security. So at the end of the day, it's just representing that on a different infrastructure. It doesn't change the nature of the asset. It doesn't change the obligation inherent to those assets. It's just basically give you a more efficient way to represent it and to obviously benefit from the decentralized nature of the technology.
And I guess it also opens up access to more potential investors, because at the moment, some of these systems are not necessarily open to everyone who's on the internet or open to everyone globally. Obviously, you've got to be an accredited investor, but potentially there's a much wider marketplace of people who could access tokenized assets than traditional assets.
I guess if you look at the way that the financial industry works today, or the infrastructure work, everything is siloed, right? Because if you think about the early days of banking, those infrastructure, being the first one, a vault, a physical vault, had to be as secure as possible. So we kept, building those infrastructure in silo to be as secure as possible. They were not built to exchange information, to transfer value, right? And as everyone is issuing in its own silo, then you need a number of third party that are ensuring that if you create something in your silo, you're not going to create something in another silo that is above what is authorized to be issued. And this is typically the role of a CSD, right? A CSD ensure that once you issue a security, for example, with a million shares, well, you're not going to create 1,000,010 shares, right? And that's why you have all those middlemen, those market infrastructure that are ensuring that indeed there's no value creation above what is authorized. Now you operate on a single infrastructure. Now everyone has access to the same data. So first of all, there's no need to have those third party ensuring that there is no more assets that in reality what exists, because it's becoming transparent and for everyone that this is the number of shares that exist, no possibility to create more. But as you remove those silos, everyone has access to that information. So, and probably the limitation that were inherent to distribution capability were driven by those silos or were inherent to those silos. You couldn't get out of your silo. Now, as everyone shares the same information, then you have a global village, a global marketplace where all those assets become available for everyone. Still, of course, with the limitation that are inherent to all those instruments or local regulation, but now everyone has access to the same data. So, and everyone can access to this data. So we're not talking about anymore like large bank that will become the sole distributor. And therefore, having those private banks that are, this kind of gateway to accessing high net worth individuals. Now, those high net worth individuals, all those family office will have direct access to those potential investment opportunity. So this is definitely going to change, of course, the distribution world as we know it today. And inherently, the liquidity behind all those assets, because you have an addressable market that is not limited to a silo, but in reality is the entire world.
Yes, I think it's going to really change the future of finance, which is amazing. And I think, the other aspect that our listeners are obviously very interested in is how will the emergence of digital fiat currencies, whether they're stablecoins, whether they're central bank digital currencies, which are obviously being issued and explored in many, many different countries now, how will that accelerate the adoption of tokenized assets from your perspective?
Well, obviously, when you buy something, there's definitely a cash leg. and you can automate a certain number of things, you can digitalize a certain number of things. But if the other leg, which is the cash leg, still remain on traditional rail, then you only have half of the benefit of having something happening on chain. So unavoidably, if you have a representation on chain of cash, then you have a full end-to-end process that can be indeed built on the top of smart contract. So, and this is not trivial because obviously I was referring to those market infrastructure that are, for example, ensuring that you don't have more representation of the asset than exists. So in that case now you have other market infrastructure that are managing counterparty risk, like again, CSDs, for example, because how can you ensure that if I'm selling you something that I'm going to get the cash when the cash is coming through the traditional rail. Now, if you can program that transaction, and this is really what we saw 7 years ago with those ICOs, right? I said in the beginning of this conversation that we had those smart contracts that were just implementing the notion of DVD. You wouldn't get the utility token if you didn't get the cash. Now we can do that as well for securities. You can have a smart contract that will ensure that I will not deliver the security if I don't get the cash, without the need for having an infrastructure in between that is managing counterparty risk. This is obviously something that regulators understand quite well. That's why we have this DLT pilot regime directive that now is enabling to merge two key market infrastructure, which is the trading one, so the exchange where a transaction is taking place, two people agreeing on a transaction, and the settlement one, where obviously both counterparty has to deliver the security and the cash, and where the transaction of exchanging the security and the cash takes place. Now you don't have to have that anymore because this is something that can take place in a smart contract. So both infrastructure merging ends the DLT pilot regime. So, and you can see there why it's important to have cash on chain, because if you don't have the cash leg, available on chain, then you cannot have this counterparty risk managed on chain as well. And that's just an example on how you would use, obviously, cash. Now, the second thing that probably will evolve as well is this notion of maybe commercial bank money and central bank money. Again, the notion of central bank money exists because what you want to make sure is that you're not creating more money than exists, right? And that's why everything converge always to the central bank, because the central bank is the one printing cash. So you need to make sure that as those transactions are taking place everywhere, and that's true too, because if that transaction takes place in dollar, every dollar transaction always come back to the central bank, to the Fed, obviously. So think about now a system that enables you to have full visibility on the available, amount of cash. So you don't need necessarily to make a difference between central bank money and commercial bank money, because you have the certainty that the one that is printing the money does not create more, because it has full visibility on what's happening everywhere. So this is probably not something that will necessarily change over time, but if you remove that notion of central bank money and commercial money and merge that into one single money, then you're going to accelerate all the transactions. And it's obviously not a matter of time, because existing infrastructure are quite already efficient today, whether we like it or not. But it's more about liquidity, a market that will operate 24/7, which is not the case today when you operate in certain currency, you need to operate during opening hours of, those central banks. So think about a market tomorrow or where cash will circulate globally, liquidity will circulate globally, and with power of those transactions, this is definitely a different world than the one that it is today.
And what about tokenization in regards to money? Because obviously CBDC and stablecoin is one thing, but you could also have tokenized deposits. You can have tokenized money market funds. So what we think of as money in a tokenized world might change. You might consider lots of different things that you wouldn't necessarily consider money today to be money in a tokenized marketplace.
Well, I think that it really depends how you're going to make use of those representation of cash. Obviously, a stable coin, does not inherently produce interest unless you place it, in a deposit account, right? Where you see money market fund, for example, invest in underlying instruments that are bearing credit. So therefore, you also have the immediate benefit of investing in something that has a stable value, but that is also creating revenue every day, every month, depending how they're going to accrue and distribute those. So I think that, again, depending of the use case, we will see a wide variety of instruments that, again, will be used as an equivalent of cash to facilitate transaction and potentially, be fed into DeFi application that will be adding yield on the top of yield, because indeed you will have also a market where people will have more access to liquidity, and again, increasing liquidity, increasing flux will facilitate, the appearance of new type of instruments, leveraging the blockchain to simply leverage its capability to accelerate transaction and therefore create liquidity and more revenue for those having position in those instruments.
Yes, I think the whole concept of money will potentially be very different, or at least, what we consider could be used as money. I think somebody else I heard described it as a bit like, you have all these different, reward points, maybe air miles and, vouchers and so on, and you can't necessarily use them all widely. You can only use them in a kind of closed ecosystem, but potentially this allows people to start using these different types of value in different ways in different parts of the market that they haven't done before. So again, as you say, being able to link that with then decentralized finance applications, suddenly you've got, a lot more opportunities for people to, to generate yield and to just make their money work for them. So sort of final question, I guess, and it's a bit controversial maybe since I'm sitting here in Britain and you're over in Europe, but which do you think will come first, the digital euro or the digital pound?
Interesting. I think that, of course, a digital euro would mean that there is a much broader consensus. So maybe you have the benefit of having remained in pound and the Brexit, but of course it's more difficult to have a consensus across numbers of countries to issue a digital representation of a currency that you would have in the UK. And it's clear that if you have one central bank, it's quite easier to have a consensus than if you have to have the approval of many more. So, but we can have a surprise, right? I think that everyone understands now that a digital representation of the currency is essential, because you need to retain the control on your interest rate, and you don't want another stable representation or central representation of cash becoming the refuge for as the USD has been for so many decades. And of course, as I explained earlier, it's not only about being the leader in the adoption of such a representation, but it's also how that representation will start creating all the use case that we've been discussing, for the last 20 minutes, and therefore will become will enable to increase the attractiveness of your financial ecosystem. So I think that this is where I see potentially the greater benefit is the currency that will be the first one to bring in the market such a representation will also be the one that will attract all those use cases, and therefore will be the champion of that digital economy.
Yes, well, in that case, I very much hope that it's Britain that takes the lead. And, we've always obviously had strong financial markets here, particularly in London. So I hope that, we will be leading the charge. But Daniel, thank you
I
very
guess
much.
it's not so much about leading, it's really about being the catalyst for adoption and acceleration. So I would be happy if UK is the first one, because that means that the other will follow up closely as well, because they cannot be left behind. So and that's really where the challenge is more. It's more about acceleration. So we know that it's going to happen, but when?
Yeah, sure. And of course, I mean, we wouldn't be the first. There are already CBDCs launched in other parts of the world. So
UAE and China,
yeah,
obviously, and
we
other
have
countries.
a number of different iterations and different people experimenting with retail and wholesale and so on. But yeah, I think the momentum is generally moving in that direction, and the momentum for tokenization is also going ahead. Maybe not as quickly as we like, as you say, but certainly moving towards that direction. So really great to talk to you about all of that. Thank you very much for being with
My
us.
pleasure.
Yeah, look forward to speaking to you again.